and which is pretty much on the expected line, because even though the inflation in the US has begun to come down, they still say that the inflation is higher than the target, and they want to keep the real rates positive for a while so that the inflationary concerns are addressed on a structural basis. Now, there is a little bit of disconnect between the market and the Fed, because market is watching the inflation numbers coming down, and market is also factoring in the fact that the factors which were contributing to inflation have also begun to help. For example, the natural gas prices, which had gone to high of $9 plus, are now at about $2.50. Just about a month, 6 weeks back, the natural gas prices were at about $5 plus. So they have corrected by more than 50% in just the last 6 weeks. The oil prices continue to soften. On the other hand, there is a little bit of concern on a revival in the inflationary trend if China opens up with the vengeance. And we have already seen the Chinese PMI number this month cross 50 threshold again, which means that the China economy is again in the expansionary mood. So while the market is projecting the current trend and expecting the inflation to continue to come down, and also market is focusing on the softening economic indicators on the growth side, the Fed is still focused on the inflation, which still remains higher than the target. So I think at this point, like in the last year when Fed was saying that the rate hikes will be slow and they were welcoming inflation, it will be more appropriate to look at the emerging trend. And therefore, I think it's a fair conclusion that Fed will go into a pause mode, maybe in the next meeting. I'm quite aware that Chairman Powell said that the Fed will continue to hike rates, but I think the market is building expectation that the Fed may pause in the next meeting in March or at best in May. And I think that's a real possibility the way the data is coming in.
Will this pause mean for the Indian market, Mahendra? Because now the Fed outcome is out. We are done with the budget. RBI has also maintained its stance that they are doing whatever possible to control inflation, and also the focus is now on growth. But this pause coming, what it means for Indian market and inflation in India?
So inflation in India is primarily driven by the global factors. And we had seen that in the months of April and March, when the oil prices had gone well above $100 and so on, our inflation also had hit a high of 7.5% plus. But now our inflation is already down to 5.7%. RBI is projecting the inflation to fall further to close to 5% in the next couple of months. RBI has already hiked the rates to close to 6.25%. We have the RBI monetary policy review meeting next week, where we are expecting another 25 basis points rate hike, with which the repo rate goes to 6.5%. The global central banks are now moving closer to a pause status. And our real rates, if you assume that inflation is at 5.7, are already in the positive territory. So with that, India is amongst very few countries like Brazil and Mexico where the real rates are positive. And therefore, from the perspective of India, where the growth momentum is showing a bit of a slowdown trend, it is appropriate in our view that going forward, after the rate hike that may be possible on 8th February, RBI will go in a pause mode. Now, that means that the rate hike momentum is then over. But at the same time, for the rates to come down, you need far more favorable factors. So we have just seen that while the government has maintained the fiscal deficit at a reasonable level of 5.9% in the budget announced yesterday, and the overall borrowing program is something which the market can absorb quite comfortably, but it still doesn't give us room for the rates to come down in a very significant way, at least in a quick time. So we are still having core inflation, which is above 6%. The inflation headline basis is below the 6%, the upper band of the RBI's tolerance limit, but still on the higher side. So our sense is that while the long-term rates might have peaked, in the current cycle, and RBI may move to a status quo mode after the policy next week. The interest rates will remain range bound, and our best hope is that they don't go up from here. But any meaningful easing in the interest rates in a quick time is, I think, something which will have to wait for far more favorable developments to take place.
So, talking about Jerome Powell's statement itself, a lot of it will be data driven, but specific focus was also on the jobs data. It looks like a lot of decision depends on the outcome of the job data. Can you please explain us the significance of that and how is it linked with the hiking of interest rates for the Fed?
So the Fed has twin objective to maintain the maximum potential employment and to control inflation. Now, obviously, the conventional wisdom is that if the employment situation is very tight, which means that the job market is very tight and there are too many job openings and there are not too many people available for those jobs, then it tends to higher wages, and then that in turn leads to higher demand and therefore inflation. So low unemployment rate is generally associated with a possibility of a higher inflation in the coming months. But Fed clearly said yesterday that if the employment situation remains healthy and at the same time if the inflation can come down, then that is the best situation they can have. Now, at the moment, the employment situation in US still seems to be very healthy. The unemployment rate is still around 3.5 to 3.7%. We have heard a lot of news about the firing in the tech sector. A lot of the big tech companies have fired a number of people, but then in proportion to the total size of the US, tech companies are not very significant. So overall job momentum is strong. But more important is that the inflationary trend is beginning to subside. The incoming data, to the extent we have now, clearly suggests that inflation should continue to come down. Therefore, I think the Fed would have been extremely worried if the unemployment rate is low, but the inflation is continuing to harden. But we now have a situation where even though the employment rate is very healthy, the inflation is coming down. So I think the Fed will not be too hassled or worried about the unemployment rate as long as the inflation continues to ease. So let's say if by March, the headline inflation in US comes close to 4.5%, then I think Fed will be happy that the employment situation is good and the inflation has also come down.
But do you think the way things are unfolding in the US is very optimistic, at least as compared to what was expected?
So that is a good news. As I said, I mean, the people were drawing three scenarios: deep recession, shallow recession, and then